Eric Mother, mother.com. Let's take a look at the chart for BP going back to 1990, monthly chart, and let's use this for an example of what to look for major highs and major lows in a stock. Let's go to the lows here of about 2000, actually excuse me, of 92, not 2000, and we can draw a line from here because on hindsight this was the breakout right there. That breakout brought the stock off the lows there and has been successful because obviously the stock is trading well above that period or that price range. So we know that if we draw a line from here using our uniformity principle, whenever we bounce on this line we should get a major low, especially if the bounce is with uniform activity. Here we have double bottom support for the lows of late 02, early 03, which coincides with those lows. Successfully the stock bounced. You got uniform activity here below the green line and back above it for the lows there, and here we got uniform activity bounce, and you got a nice recovery in the price. Recently we came and tagged this level here for the lows right there. Now keep in mind this period here so happens to be when we had that BP oil crash fiasco, and was a very volatile period in the stock. But again, if you take a look at what happened here at the lows, at these lows, you can also see that there's signs here, good signs that we went lower in terms of monthly closing lows, but the RSI had a slight improvement. Okay, so that's a very good positive divergence. Keep in mind during these lows here the RSI failed or was rejected when it tried to go below 30.9, and that's a big deal. So this failure to move below 30.9 was a sign of strength, and of course you combine that with our previous line. So in other words, we had two things going. We had support with uniform, let me take that off here. So we had support on this line, uniform action below the green line and back above it, and then also we had an improvement in RSI strength after prices recorded fresh monthly closing lows, and of course since then the stock has gone to trade higher. So really there's no need to spend a lot of time trying to follow some of these instruments, if at all to follow any instrument based on news, because if you use the charts they are more simple and they can actually give you a better idea and sense as to what could take place. Let's take a look at the most recent highs in the stock. So one thing I do see here is we had an improvement in price highs on a monthly closing basis, but this corresponded with the RSI making a lower low or a lower high, excuse me. Also, it was rejected here as it tried to move above 69.1. Of course 69.1 is just the exact opposite of 30.9. You add the two, you get 100. Check the description of the video for more into this, where we get these numbers. But just keep in mind here at the highs you had RSI not showing any improvement, RSI showing rejection when you tried to move above 69.1. That rejection was with uniform activity, as you can see there, and all that time period the prices were making a new high. Of course that's a red flag. Okay, during the highs here. Of course since then we are trading lower. Let's take a look at other major highs since then, and we can see that if you take a look at this break in 06 that led to a shallow pullback, and then now we draw a line from there. You can see that here it gives us the actual highs, uniform activity rejection, almost like a triple top here, here, and then again here for the actual highs there. And of course, we've been lower since then. Now you can test that red line by going backwards. It's always good practice to do that to see how the stock responds. If you go backwards, you can see it gives us this sell period here of the highs there in late 99, early 2000. So drawing simple lines and using the RSI is pretty much the best way you can time instruments, rather than spending a lot of your time and effort trying to figure out what the news media is pumping out. Eric Moore, the mother.com. As always, good luck, peace and blessings. I am out. Mwah.